Welcome back to the channel. If you've been watching the metals market lately, you've probably noticed something a little strange. Gold has been holding strong, sitting near all-time highs, and getting a lot of attention in the news. But silver has been quietly falling behind. The gap between these two metals has stretched to levels we rarely see, and historically, every single time that gap has gotten this wide, something very interesting has happened next. That's what today's video is all about. Now before we go any further, let me be clear, this is not financial advice. I'm not here to tell you what to buy or sell. I'm here to break down what's actually happening in the metals market right now, explain a specific ratio that professional investors watch very closely, and help you understand why a lot of experienced, patient money is starting to pay serious attention to silver at this particular moment in 2026. Whether you act on any of this is completely up to you, but understanding the dynamics is something every investor should have in their toolkit. So let's set the stage. Gold has been on a remarkable run. Central banks around the world have been loading up on it. Inflation concerns, geopolitical uncertainty, and fears about currency devaluation have kept demand strong. Gold has been the headline story in precious metals. Silver, on the other hand, has been moving in a completely different direction relative to gold. It's been lagging, underperforming, and largely ignored by mainstream financial media. And here's the thing, that gap, that disconnect between the two metals is actually the real story, because it's not just an interesting observation, it's a signal that traders and institutional investors have studied for decades. To really understand what's happening, you need to understand the relationship between gold and silver, and specifically a tool called the gold-to-silver ratio. This ratio sounds technical, but it's actually one of the simplest concepts in commodity investing. All it tells you is how many ounces of silver it would take to buy 1 ounce of gold. That's it. If gold is trading at $3,000 per ounce and silver is at $30 per ounce, the ratio is 100. It takes 100 ounces of silver to equal the value of 1 ounce of gold. When that number goes up, silver is getting cheaper relative to gold. When it goes down, silver is getting more expensive relative to gold. Here's what makes this ratio so powerful. Over a very long period of time, we're talking centuries, gold and silver have maintained a fairly consistent relationship with each other. In nature, they're found in the Earth's crust at roughly a 15-to-1 ratio. During the gold and silver standard era in the United States, the official government ratio was set close to that range. In the modern era, as markets became freer, the ratio has fluctuated, but it has tended to average somewhere between 40 and 80 over the long term. When it stretches far above 80, historically, that has often meant silver is unusually cheap relative to gold. When it drops below 40, silver has been unusually expensive. Right now in 2026, the gold-to-silver ratio has climbed into territory we only see a handful of times in modern history. It has pushed well above 90, and in recent readings close to or beyond 100. Think about what that means. It means silver is, relative to gold, near its cheapest levels in modern times. And that's not random. There are real reasons it got here, and real reasons why this matters going forward. Let's break down both sides of that. First, why did the ratio get this extreme? Gold has been driven by fear and macro concerns, central bank buying, inflation hedging, geopolitical tension. These are things gold is perfectly suited for. Its reputation as a store of value and safe haven makes it the first choice for big institutional players who want to park money somewhere stable. Silver doesn't carry that same safe haven identity. It's seen as more volatile, more industrial, more speculative. So when fear drives money into metals, it floods into gold first, and silver gets left behind. That's one part of the story. The second force is industrial demand expectations. Silver has a dual identity that gold doesn't share. About half of silver's demand every year comes from industrial uses: electronics, solar panels, electric vehicles, batteries, medical devices. Silver is one of the most electrically conductive materials on Earth, which makes it genuinely irreplaceable in a lot of modern technology. But industrial demand is tied to economic activity, and when growth expectations soften or uncertainty rises, industrial commodities tend to underperform. That's another reason silver has been lagging. The third factor is market psychology and momentum. When something is going up, money chases it. When something is drifting sideways, money ignores it. Gold has had momentum and a strong narrative. Silver hasn't had that same story driving it recently. Capital has flowed toward gold and away from silver, and that sustained imbalance has pushed the ratio to these extremes. Now here's what gets the smart money excited. Every single time in modern history that the gold-to-silver ratio reached these extremes, every time it pushed to 90, 100, or beyond, silver has eventually snapped back. Not always immediately, not always in a straight line, but the reversion has happened. And when silver closes that gap, it doesn't close it slowly. It tends to close it fast and aggressively. That's the nature of silver. It's a smaller, thinner market than gold, so when money pours in, the price movement is often dramatic and swift. Look at the historical record for a moment. In 2020, when the COVID crisis hit and fear was everywhere, the ratio exploded above 120, the highest level ever recorded in modern times. Silver had been crushed, but within just 12 months, silver ran from around $12 per ounce to nearly $30 per ounce, and the ratio compressed sharply. That was a massive move in a short period of time, and it came right out of one of the most extreme ratio readings in history. The pattern has repeated itself in various forms across multiple cycles. Now I want to be honest here, because giving you the full picture matters more to me than selling a one-sided story. The ratio being high does not automatically mean silver is about to surge. That's not how markets work. The ratio can stay elevated for a long time before it reverts. It can even stretch further before it corrects. Silver has extended these timelines before, and there are real scenarios where silver continues to underperform. If global industrial activity stays soft, if a serious recession hits and technology demand falls, or if gold itself corrects and drags silver down with it. These are legitimate risks, and they deserve honest acknowledgement. What the ratio tells you is not when silver will move. It tells you where silver is priced relative to its historical relationship with gold. It's a valuation tool, not a timing tool. Think about it this way. Imagine you're shopping for a house. Historically, homes in a certain neighborhood sell for between $300,000 and $500,000. If you see one listed at $180,000, that doesn't automatically mean you should buy it today. Maybe there's a flood risk, maybe the foundation needs work, maybe the market is in a downturn, but it does tell you that relative to what you'd normally expect to pay, this is an unusual entry point. You'd want to understand why it's this cheap and what the risks are. The gold-to-silver ratio works exactly the same way. This is the concept that experienced investors call a buy zone. When the ratio stretches above 80, 90, or 100, historically speaking, silver enters a zone where the risk-reward dynamic starts to shift. You're not paying a premium for silver. You're getting it at a discount relative to gold. And if history rhymes, which it doesn't always, but it often does, silver from these levels has historically had a better chance of outperforming gold over the following several years than it would if the ratio sat at 50 or 60. So why is smart money paying attention right now? When I say smart money, I mean institutional investors, family offices, hedge funds, and experienced commodity traders who think in multi-year cycles rather than day-to-day movements. These are people who study fundamentals, historical patterns, and supply-demand dynamics, and they make calculated, patient bets when the odds seem to favor them. Right now, several things are converging that are drawing that kind of attention to silver. The ratio itself is the foundation, and we've covered that. But the second thing is that the industrial demand story is actually strengthening despite recent weakness in silver's price. Solar panel installation globally has been hitting records year after year. Electrification of vehicles continues to expand. 5G network infrastructure requires silver. Artificial intelligence data centers require massive amounts of electronics, which require silver. The demand side of the silver equation, looking out 3 to 5 years, is genuinely compelling. And here's the critical piece: silver supply is not unlimited. Silver is primarily mined as a byproduct of other metals like copper, lead, and zinc. You can't simply ramp up silver production overnight just because prices start rising. Supply is relatively inelastic in the short term. When investment demand eventually gets layered on top of industrial demand, that combination can create serious price pressure. The third thing institutional money is watching is the monetary environment. In 2026, we're still in a world where central banks globally have expanded their balance sheets enormously over the past decade and a half. Real interest rates, that's rates after subtracting inflation, have been a major driver of precious metals. When real rates fall, hard assets like gold and silver tend to benefit. Silver, as both a monetary metal and an industrial metal, can benefit from monetary easing on two separate fronts simultaneously. That's a double tailwind that gold doesn't have to the same degree. Here's something nuanced that I think is really important for everyday investors to understand. There's a difference between how gold and silver behave in different phases of a metals bull market. Typically, when a precious metals bull market begins, gold leads. It's the safe haven, the first mover, the capital magnet for people seeking stability. Then as confidence builds and the bull market matures, investors start looking for leverage within the metals space, and silver begins to outperform. Silver has historically been described as gold on steroids for this reason. It follows gold, but it tends to move in bigger percentages in both directions. When metals fall, silver falls harder. When metals rise, silver often rises more. If we're currently at a point where gold has already had a massive run and silver is sitting at historically depressed levels relative to gold, that fits a very recognizable pattern. It looks like the early setup for a rotation. Not a guaranteed one, not a perfectly timed one, but a pattern that has repeated itself enough times over decades that serious money takes it very seriously. And this connects to something real for everyday people. A lot of investors who've watched gold's rise have had this experience. They see gold going up, they think they should have bought some, and by the time they're paying attention, gold is near all-time highs. There's hesitation. Buying after a massive run feels uncomfortable. Silver, by contrast, is in a position where the historical pattern suggests it may be earlier in its move relative to gold. It hasn't had gold's run yet. The ratio says it's still in the setup phase, not the late stage. Now that could mean opportunity, or it could mean there are still headwinds that will delay the move. But the entry point looks very different from a historical value perspective. This is also why the idea of rotating within metals is so interesting right now. Some investors who already hold gold aren't exiting metals entirely. They're looking at the ratio and asking whether their capital might work harder in silver over the next few years given how stretched things are. They're not abandoning metals. They're rebalancing within metals. That's a thoughtful, historically informed approach, rather than just chasing the hot story. I want to take a quick moment here. If you're finding this useful, please hit the like button and subscribe if you haven't already. I put real work into researching these topics and presenting them clearly and honestly. Your support genuinely helps this channel grow and keeps this kind of content coming. All right, let's keep going. Let me address something you might be wondering. If silver is so undervalued relative to gold, why hasn't the market already corrected it? Why is this opportunity sitting on the table? Honestly, markets can stay inefficient for longer than most people expect. There are a few reasons the reversion hasn't happened yet. One is that in a fear-driven market, people move toward the safer of two related assets. Gold gets the capital and silver waits. This can persist for extended periods. Two is that the industrial demand thesis, while compelling for the future, is competing against near-term concerns about global economic growth. If investors are worried about recession, they're also uncertain whether solar panels and electric vehicles will be built at the pace analysts project. Forward-looking theses take time to materialize. Three is that silver is a smaller market and often needs a specific catalyst to get moving, a dovish shift from central banks, a surge in industrial orders, or simply a tipping point where the ratio itself becomes so extreme that reversion is forced. Markets have their own timing, but when those catalysts arrive, silver tends to move quickly and sharply. Investors who are positioned ahead of that move, who bought into the buy zone while mainstream attention was on gold, are typically the ones who capture the most significant returns. This is the logic of contrarian investing. Find things that are out of favor for temporary or cyclical reasons, not structural or permanent reasons, and have the patience to wait. Let me also talk about the role of the dollar, because it's a variable that often gets overlooked. Precious metals in general have an inverse relationship with the US dollar. When the dollar strengthens, metals often weaken because they're priced globally in dollars. When the dollar weakens, metals tend to strengthen. There are competing forces on the dollar right now. Relatively higher U.S. interest rates have supported it, but the scale of U.S. debt, ongoing fiscal deficits, and geopolitical moves to reduce dollar dependency in global trade create a longer-term headwind. How this plays out matters for metals. If we see dollar weakness, both gold and silver get a tailwind. Silver's industrial demand provides some cushion because it's driven by global economic activity, not just dollar dynamics. But it's still a factor worth monitoring. Now let me talk about something underappreciated. Silver's specific role in the energy transition. Solar panels use silver paste in their photovoltaic cells, and this isn't an ingredient engineers are trying to substitute away due to cost. Silver is used because it's the most electrically conductive metal on Earth, and that conductivity is critical to efficiency. As global solar installation continues to grow, and projections suggest strong growth over the next decade, the demand for silver from this one sector alone is significant. Layer on top of that the silver used in electric vehicle electronics, battery management systems, expanding 5G infrastructure, and medical technology, and you begin to see why the fundamentals for silver demand over the next 5 to 10 years look genuinely strong. The question is whether investors wake up to that story before or after the price has already moved. Let me now give you the big picture mental framework that ties all of this together, because this is the takeaway that matters most. Gold and silver move in the same broad direction most of the time. When the macro environment favors precious metals, loose monetary policy, inflation concerns, dollar weakness, geopolitical uncertainty, both tend to rise. But they don't rise at the same pace or at the same time. Gold typically leads, silver follows, and because silver is a smaller market with both monetary and industrial demand drivers, it tends to exhibit bigger percentage moves in both directions. The gold-to-silver ratio is essentially a real-time thermometer for where we are in the relative cycle between these two metals. When the ratio is low, below 40, silver has outrun gold and may be overextended. When the ratio is high, above 80 or 90, silver has fallen out of favor relative to gold, and historically those conditions have created the setup for a reversion. We're currently in the high ratio phase. The thesis that smart, patient capital is beginning to explore is essentially this: the macro tailwinds that have driven gold higher are starting to build potential tailwinds for silver as well. But silver hasn't participated yet. And when silver eventually participates, it often does so dramatically. One more thing I want you to think about: patience and time horizon. The ratio can tell you silver looks historically cheap relative to gold. It cannot tell you when silver will close that gap. The move could start this year. It could start in 2027 or later. What history tells us is that the move tends to happen eventually, but it doesn't come with a precise calendar. Investors who approach silver with a realistic multi-year time horizon tend to do far better emotionally than those who buy expecting a big move in 3 months and get frustrated when it doesn't arrive on schedule. You need to be early before you're right, and being early can feel uncomfortable. Right now, sentiment towards silver is genuinely poor. It's not making headlines. It's not what financial influencers are talking about. And interestingly, that's often exactly the environment where the best long-term opportunities develop. When everyone is talking about an asset, when it's on the cover of every magazine, when your neighbor mentions it at a cookout, that's often when it's crowded and expensive. Or when nobody is talking about it, when it's sitting quietly being ignored, that's often when it's cheap. Silver today feels much more like the latter. So to pull this all together, here's the story as it stands. Gold has had a remarkable run driven by legitimate macro concerns that remain very much in play. Silver has lagged gold significantly, and the gold-to-silver ratio has stretched to historically extreme levels. Every time this has happened in modern history, silver has eventually staged a meaningful reversion, catching up with and often outpacing gold over a period of months to years. The fundamental demand story for silver, driven by the energy transition, industrial technology, and monetary factors, is compelling for the medium to long term. Supply is constrained, and sentiment is low, which from a contrarian standpoint is actually a constructive ingredient for a setup. None of this means silver is guaranteed to move tomorrow. None of this means it carries no risk. It's one of the more volatile assets you can hold, capable of sharp drops as well as sharp rallies. What it does mean is that from a historical, fundamental, and relative value perspective, silver is in a position that serious investors find genuinely interesting. The kind of interesting that's worth understanding, worth watching, and worth thinking through carefully relative to your own financial situation and goals. That's going to wrap it up for today. If you got value from this, please give it a like and subscribe to the channel if you're not already. I cover markets, economics, and investing with the goal of making complex ideas genuinely clear and honest. No hype, no sensationalism, just straight thinking. I'm John Smith, and I'll see you in the next one.